Amazon recently announced that it was splitting its stock 20-for-1. This is the first time in more than 20 years that the tech giant has chosen to split its shares. The market seemed pretty excited by this news, and Amazon stock jumped about 5% after the announcement was made. What does all this mean for investors in Amazon like me? Here's everything you need to know about Amazon stock split. My name is Brian Feroldi. Thanks to Quarter for sponsoring today's video. Let's start with the news. So on March 9th, 2022, Amazon's board of directors approved a 20-for-1 stock split. Now, the stock split and the authorization to increase the number of shares still needs shareholder approval, and that vote will take place on May 25th, 2022. If everything goes through as planned, what will happen is that on May 27th, every shareholder of Amazon will all of a sudden receive 19 additional shares for each one they hold. So if you own one share of Amazon before the split, you will suddenly wake up with 20 shares of Amazon after the split. Now, this news really excited the markets, and shares jumped about 5% when the announcement was made. And with shares currently trading about $2,900 per share, does that mean that investors are going to be in for a sudden windfall? Unfortunately, that's not how stock splits work. See, with Amazon splitting its stock 20-for-1, the total number of shares that are outstanding is going to go up by a factor of 20. To compensate for that, the share price also has to fall by a factor of 20. So with shares currently trading for about $2,900 each, that means that those 20 shares you're going to get are going to be worth about $145 each, which is 1/20th the price. So notice that if you had $2,900 invested in Amazon before the split, you'll have $2,900 invested in Amazon after the split. Another common misconception about stock splits is that some investors believe that Amazon stock will have an easier time doubling or tripling with the much lower share price. So some people believe that a $145 stock has a much higher chance of becoming a $290 stock than a $2,900 stock has a chance of becoming a $5,800 stock. Well, unfortunately, that's not how it works either. Rather than focusing on the share price, I want you to focus on another important investing metric, and that is called market capitalization. So what does market capitalization mean? This is just the total dollar value of a company's equity. It's essentially a measure of what a company is currently worth. Now, the formula for market capitalization is extremely simple. It's just the last share price times the total number of shares that are outstanding. So let's do that calculation for Amazon. Amazon is currently trading for about $2,900 per share. But how do we find out how many shares are outstanding? Well, there's lots of ways that you can do this. One of the ways that I like is to go to the most recent earnings report and look at the income statement. At the very bottom of the income statement is listed the total number of diluted shares that are outstanding as of the end of the year. In Amazon's case, there are 516 million shares outstanding currently. So if we do that math, $2,900 share price times 516 million shares outstanding, that gives us a market capitalization of about $1.5 trillion. That is the current total equity value of Amazon's common stock. And this number is easy to find up without doing that math. If you go to sites like Yahoo or Google, it's always reported as one of the company's key statistics. So if we as shareholders are hoping that Amazon stock is going to double, it doesn't really matter if the stock is trading at $145 per share or $2,900 per share. What we really think is going to happen is that the company's market cap is going to go from $1.5 trillion to $3 trillion. That's what needs to happen for Amazon stock to double from here. All right, I just threw a lot of information at you, so let's quickly recap. Before the stock split, Amazon was worth $1.5 trillion, and that was made up of $2,900 share price times 516 million shares outstanding. After the stock split goes through, Amazon is still worth $1.5 trillion, but there will be 10.32 billion shares outstanding, and each of them will be worth about $145. So the before and after pictures on the market capitalization are unchanged. It's just the dollar price of one share that is really changing. Well, you might now be thinking, well, are stock splits non-events? I actually think there's 5 good reasons that investors should be happy about this stock split news, which I'll get to next. Before I do so, I wanted to give a shout out to this video's sponsor, which is Quarter. Quarter's mission is to make every interaction between companies and their investors meaningful. Quarter does so by providing frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world straight to your pocket for no cost. If you're interested in giving Quarter a try for free, simply visit the App Store of your choice and search for Quarter. That's Quartr. All right, so if indeed stock splits don't really matter that much, why do I think they're a good idea? Well, let's turn to reason one. After a stock split, Amazon stock will become much more accessible to small individual investors. A lot of investors don't like the idea of buying into a stock that's trading at $2,900. Maybe they don't have $2,900 to invest in one company, or maybe their broker doesn't allow them to buy fractional shares. For that reason, there are some investors out there that want to invest in Amazon, but because Amazon stock is trading at such a high dollar price, they don't want to do that. Reason number two to split a stock has to do with the company's own employees. Many of Amazon's employees are paid with stock-based compensation. In some cases, employees only own a handful of shares themselves, and if they want to sell their position, they often have to unload a sizable portion of their Amazon position to do so. By lowering the share price by a factor of 20, Amazon's employees might have a much easier time selling a portion of their stock instead of all of their stock to fund a purchase. Reason number three has to do with the Dow Jones Industrial Average. The Dow Jones Industrial Average is one of the most famous stock market indices in the world, but the Dow uses a company's share price to determine the weighting of the indices. If you look at the current composition of the Dow 30, all of the companies that are in the Dow trade between $47 and $500 per share. If Amazon was to be included in its current share price, it would have about 6 times the weighting of the current largest Dow component, which is United Health Group, and nearly 60 times the weighting of the smallest Dow component, which is Intel Corporation. For that reason, there's no way that the Dow Committee would currently consider adding Amazon to the Dow Jones Index in its current incarnation. Reason number 4 has to do with options holders. We've never talked about options on this channel, but if you want to buy or sell options, all options transactions take place in lots of 100 shares. Now, 100 shares times a $2,900 stock price is $290,000 for each option contract. That's a lot of money, even if you're managing quite a bit of money on your own. By splitting the stock 20 for 1, that reduces each option contract from $290,000 all the way down to $14,500. Now, that's still a lot of money in absolute terms, but if you're interested in buying or selling puts or calls on Amazon, it's much easier to do so with a lower share price. And then the final reason that it's a good thing when companies split their stock is there's often a lot of short-term excitement. We've seen this in recent years when other companies have announced to split their stock, such as Tesla, when it announced a 5-for-1 stock split in 2020, its share price got a boost. When Apple announced a 4-for-1 stock split in 2020, its share price got a boost. When Google announced a 20-for-1 stock split earlier this year, its share price got a boost. Now, if you've watched this channel for any period of time, you know that we focus on the long term and not the short term. But given the positives that I just mentioned, I don't really see a reason for a company not to split their stock. So when I think about companies like Shopify or Equinix or Mercado Libre or AutoZone or Booking Holding, given the 5 upsides I just mentioned, I think the positives of splitting your stock far outweigh any potential negatives. So yes, while it's true that stock splits don't really create any actual value for shareholders, the positives of doing so really outweigh the negatives. So I don't see any reason for companies not to split their stock. Now, in that same stock split announcement, Amazon also announced that it was doing a stock buyback program. If you'd like me to make an explainer video on what a stock buyback is, let me know in the comment section below. Hope this video was helpful. Brian, out.